Hello everyone. Welcome to the macroeconomic update for April 2022. So we have Karthik Damodar, the founder and CEO of Dragon Capital, and Rushabh and myself, Ratik, who will be doing further research on the macroeconomic update.
Before we get started on this, just to let you know, the objective is to give you an idea of how the economy is done over the month and where are we headed. So let's start on it. So we thought we'd break it up and keep it really simple. GDP equals to consumption plus investments plus government spend plus exports minus imports. In each one of these variables, we have taken out a few metrics. We thought these were key to give you an idea of how are we progressing over last month and what to expect going forward. Okay. So we can start with consumption.
Right? Yeah. So for coming with the consumption, we have three variables that we look into. First point is the power supply. The second is towards the unemployment, and the third is inflation. So what does power supply help us with? How much is the power generated over the year and over the month, and what has been the long term for that?
Yeah, and the more power that is generated, the better it is. It means that there is more industrial production going on, there is more activity going on, which would be good, which would give an indication of essentially the GDP is growing. Okay? We have Excel sheets also if you want to take a look at it. But let's give the gist of how this is working out for last month first.
Yeah. Right? So for the last month that we have seen is a 4%, a 3% growth in month on month. Basically, we have seen a power generation being more in the April month than March month. This could be a reason of because of the heat peak summer season that we have seen the growth. And for a long-term average, what we have seen is that the power generation has grown on a 4% approximately. And the chart over here that you see is we can see that when the power generation started, we tracked the data from approximately mid of 2018. From there, we are seeing a single line coming out. So as such, no major growth in this.
So historically, to summarize, the growth hasn't been what we would expect it to be. If you look at the last month over month, the growth has been about 3%. Year over year, this is interesting, it's been about 10%. But April of last year, if you double click on the formula here, was a lockdown. So the base was also much lower.
Yes.
Right? So there has been some sort of output. Some of it would be probably because of the summer months, but also the base is very, very low, which gives you a false sort of idea of huge growth. But there is some degree of incremental growth when it comes to power, which is always good.
Yes. Right? And the second metric that we looked into is for the unemployment. So long-term average, what we are seeing is that if for a 10 people, we see 6 people being unemployed, and sorry, as 1% approximately, and for the current, we are seeing an 0.8. So giving you a gist, we have unemployment classified into the urban sector and the rural sector. For the urban sector, we are seeing a 9.2, and for rural sector, we are seeing a 7.2. But however, looking at a 5-year average, that is pre-COVID, the unemployment in urban sector was much higher than the rural sector, and it was in line with the average as of now.
So to summarize, over a 5-year period, it's been about 7% unemployment, and it is higher right now. So that is always never good. The worry comes from urban sector. So in the urban sector, virtually for, there's about 9% unemployment, right?
Yes.
So yeah, so about from 100 people, 9 to 10 people are unemployed, which is very, very high, which is a sign of also the economy not really on full power, if it was a car, because there are a lot of people looking for jobs out there who can't find the job. As the economy picks up, a lot of these people hopefully get jobs out there, but it's been very, very, very high over the last month. Okay?
So the next metric that we'll be looking into is the inflation. So what does inflation depicts is basically how the consumer is paying for a amount for his necessities. That could be the core index. And coming to the Excel, what we are seeing is The core inflation for the current year is 7% growth YOY. And the major component towards it is the clothing and footwear, where you're seeing a 10% YOY increase. And for the fuel and light, that could be majorly on account of the geopolitical tensions and crude oil prices increasing. So we are seeing 11% growth over here.
So also to summarize, the RBI normally likes keeping inflation in the 4 to 6% range. When you see inflation going above 6%, there could be two reasons for it. And in this case, there are two reasons for it. One is from the supply side, where there is a restriction in supply, so then prices go up. And from a demand side, where there is a tremendous amount of demand, and which is why prices go up, right? So right now, when you see inflation creeping up, there's a very good chance interest rates keep going higher and higher to curb this inflation. Food is a large component for most of India. You see food inflation at about 8%, and it's been consistently high. So that's a very, very big worry. And since you've seen what's happened in the, call it the Russian war, you've seen also fuel inflation creep up extremely high. And these are two large components of an average person's budget. And this would really be the focus for RBI. This would be one of the reasons why the government has curbed certain exports, is to hopefully bring prices down and keep it in that 4 to 6% range. So then to summarize, if we go to the three variables that we have, power supply is marginally up, which is a good idea. Unemployment is high, which is not a great indicator. And inflation is also very high, which is really not a good indicator as well, right?
Yes.
So on the consumption side, I think safely put, with everything else that we've seen, the story is not great for the month, and hopefully over time this should get better.
Yeah.
Ratik will take you through the investment side now.
Yeah. So the investment side, what we look is into how much is the investment being flown into the by the foreign investors and the domestic investors, and how the mutual funds are doing it. So what we see is that there has been an outflow coming from October itself from the FPIs. However, for this current month, we have 9,600 basically for April. But one thing that we would like to note you for is the May month, where we are seeing a 35,000 crores of outflow from FIIs.
So to give you a summary, FIs on an average put in about 6,500 crores a month. And if we look at the numbers from October to April, which has been given, there's been an outflow for about 1.5 lakhs. Plus, if we look at this month, where there's an outflow of about 50,000 crores, 35,000 crores. So, that's a tremendous outflow. Is the rate of outflow slowing down? No. Because last month was 9,000 crores, and this month you're saying is 35,000 crores. And so that's, we've read some articles where they've said that essentially, if you look at the last 7 years, what FIs are put in, that entire thing has been taken out.
Yes.
Right. And how this affects us is essentially FIs, pension funds, normally put money in the large caps. So they start taking money out, and banking, financials is a large component of the large caps. A lot of money gets taken out of those stocks. But what we've also seen is the DIs for the first time have invested heavily.
Yes.
To sort of bridge that gap between the FIs. Normally, DIs put in about 5,000 crores. Domestic investors put in about 5,000 crores a month. Last month, it was 30,000 crores. And some of the worries that come with this is, since a lot of it is retail investments as well, that if prices don't move quickly and they don't see some sort of performance, and with interest rates rising, you could see some of this money going out.
Yes.
Right. So from a supply side and demand side for equities, we are at the stage where it looks like, if there's no incremental progress or price movements, there is a strong possibility that you will see DIs also pull out money. Interest rates go up, FD rates go up. There's a greater incentive to go back and put some money into FDs. But that doesn't really give you an idea of how these companies are performing. At Guardian, what we've said is, if you keep the prices aside and the earnings of those companies grow by, say, about 15%, over a 5 to 7 year period, you will also see the prices go by the same proportions. So if FIs are pulling out, which is true, and presume DIs also at some point start taking money out, that would actually be a good thing for us because it would provide more opportunity to buy the same sort of quality companies at a cheaper price. On the mutual fund side?
On the mutual fund side, what we are seeing an average is the mutual funds put in equity of 11,000 crores a month, and on debt side we see 8,000. So this month, what we have seen is typically half of what it has been in long-term average. What can we infer is basically they are not going behind the prices, but behind the quality companies and looking to stack the cash for the future investments.
Yeah. So essentially, flow of money has definitely slowed down.
Yes.
You said flow of money has slowed down, and then when you come to consumption, you've said it's not looking great with high inflation. The only plus point is maybe power supply has increased a little bit, but the base was also very low, right? So consumption is not a great story. Investments is also not a great story at this point in time. Government spend for the last month, the government has not released that data yet. But on an average, holistically, we can give a sort of idea that for every 100 rupees that the government makes, about 30 rupees is being used for paying back 30. No, now it is 40 rupees.
40 rupees
is being used for paying back interest payments.
Yes.
So there's not much flexibility over there from the government side. And for every 100 rupees that the government makes, if you look at the spend, it's about 200 rupees. So we are spending far more than we are making. So if you were an individual making 100 rupees, you're spending about 150 rupees, sometimes 200 rupees a month. And as a result, the money is spent through, raising debt, and debt burden has gone up tremendously. So imagine an individual who has to pay 40% or 37% of the income to pay interest payments. There's not much money or flexibility in investing in the future, right? I think next month we'll go into the details of the government spend, because by then we would have got data.
Yes.
Right now we can just skip it, and essentially tells you that it's again not an ideal scenario. It doesn't look like we are at the bottom of this either. When it comes to exports and imports, it's quite interesting. Rathik will run you through this.
Yeah. So on average, what we have seen is the export is 1,95,000 crores and an import of 2,70,000, giving you a net of 75,000 crores a month. However, the great sign that we are looking is that the exports have doubled, the imports have doubled, and the net is also doubled. However, the net side is again a negative because we are seeing a net outflow of double of the long-term average. One thing that we can note from here is that the exports have doubled because of the prices increases, and as such, the major export is coming from the non-oil sectors. Basically, it could be anything as such as the services, the production, and everything. However, the oil sector as such has grown only 70%. Majorly again on account of increase in the crude oil prices.
So, there are two stories here. One could just look at the silo of exports and say, hey, exports have grown so much and we've done well. But the imports have grown far, far more, right? So there's a lot of opportunity. I think even the government is trying to go through this Make in India. There's a lot of opportunity to make over here and buy from here as opposed to import a lot of this if you can get competitive. But as of right now, if you go to the Excel sheet, if we are exporting 100 rupees, export minus imports is a deficit of
44%.
44%. So we are essentially importing 44% more than what we are exporting.
Yes.
Right. And yeah, that's also never a good sign for the economy. So if you go back to the main sheet, things don't look great. Yeah, consumption doesn't look as strong as we would like it. Investments outflows are happening right now. Government spend is, there are a lot of restrictions given the fact that a large component needs to be used for paying off debt. However, I guess the government is also, from this data, if you look at it, trying to spend as much as possible to keep the economy growing at a decent path. And if you remember the first slide, government spend was about what, 25%?
Yes.
of GDP. So it's a significant contributor. Exports, imports, again, the situation is not good. Now, economies go through cycles like this, and as an investor, we wouldn't suggest going macro to micro. There are companies in India that have performed extremely well through recessions, through the tops, and what we've actually seen over the last since the coronavirus is, if there are 100 companies in a sector, the top companies have done very well and the bottom companies have disappeared. So a lot of the money has gone from the bottom companies to the top companies, right? So while the economy might not be doing very well, it does provide opportunity for investments because hopefully prices fall and whatever we wanted to buy, we can buy it like it's on a Diwali discount. That's the summary in terms of how the economy is doing. Hope this is useful. We will send out a video next month with an update on all these numbers, and we'll add a few as well. If you have any suggestions on variables you would like to see, or any suggestions on how we present this, please feel free to get in touch with us directly. Hope you have a great month.
Thank you.
Thank you.